Welcome to the October webinar from Principal Wealth. I'm Julina Ogilvie, partner and wealth advisor, joined once again by Bob Paolucci, our founder and CEO. Bob, good afternoon.
Good afternoon, Julina. Happy fall.
Happy fall. So the title of our webinar today is Scarecrow Tactics. Very cute title that we changed several times, but we wanted to allude to the headlines and to the threats that are out there, all of the uh, stuff, right? And I'll let you get into it because I know you chose the title.
Yeah, so ultimately, you're hearing professionals question the bull market, politicians pointing fingers at each other, these loud headlines and hollow threats. And as we were talking about, there's plenty of straw stuffed into every policy debate.
Mhm.
Um, that stuff mixed with the time of year it is made it appropriate for this one to be called Scarecrow Tactics. How about that?
I like it. I
We're
like
gonna
it.
go with it.
We're going to go with it,
Yeah.
and we are going to follow our usual agenda in that we're going to break it up into the markets, the economy and policy, and then the everything else bucket. And what you will notice is that all of the titles have a October Halloweenish theme. So hopefully the listeners will appreciate that.
We'll see if anyone can catch what we're talking about.
Exactly. Okay. So let's kick it off with the markets. And the first title is The Spicy Candy is in Demand.
Yeah, so you have the S&P 500, right? We split it into two components, the high beta or high volatility companies and the low beta, low volatility companies. And what you see here, looking back over the 6 months, it is the higher volatility, spicier ingredients within the S&P 500 that have moved the entire index higher. How do we know this? Well, look at the chart. It shows that the low volatility stocks haven't actually moved in the past 6 months. So it's really all of the growth stuff, the higher volatility securities that have pulled the entire index higher. So you don't get to see it this way often. We thought it was very interesting to show you it sort of broken out like this. So we'll call this a risk on move in the markets.
Right. And it's following a similar trend that we've seen the last few years if you take that volatility out.
Absolutely.
Yeah. And let's take the return one step further. We talk a lot about the importance of earnings, but I think this really drives home how it's contributed over the last 5 years.
Yeah, so the ingredients of total return, right? It's a combination of earnings, dividends, and the desire to pay a premium for future earnings today. That would be called multiple growth, right? So have PE ratios risen, right? Generally speaking. And what you see is on the far right hand side, the cumulative combination that has defined the market move for the past 5 or 6 years is really heavy earnings growth with some dividend payments, about 19% of the return, and 30% of the return is multiple growth. So that's a incredibly high concentration in the most fundamental thing you can get in the equity market in a positive way, that is earnings growth. So for those who sort of question the path of the market and the backdrop in which it's powered, it is really driven by earnings, which is as healthy as you can get. So
Yeah.
it's not driven by just air and speculation. If that were the case, you'd have like a 1999, 2000 type scenario. We have the opposite of that. This is really driven by fundamental earnings growth.
Yeah. I think this is a great visual as to why we address earnings in every webinar because it really
Absolutely.
does show the future return.
Great.
And so let's move and talk about scarcity value.
Scarcity value.
Yeah,
How
you
about
did it better than I did. Okay.
yeah. So, the other component of return is scarcity value. So you hear about companies buying back their shares. When they do that, they are decreasing the number of outstanding shares, therefore creating scarcity value, which creates more value for the shares that you have, right? That's one part of it. The other part of it is there are fewer companies, publicly traded companies outstanding. There's a reason for that, but ultimately, um, a smaller market means that the same amount of dollars gets spread around amongst fewer companies. So, one of the main contributors to the top heaviness of the markets today is the fact that there's just fewer companies. There
Mhm.
isn't less competition. Those companies exist. They're just not in the public markets. And we'll show that to you next.
Yeah. This is a great visual of that.
Yeah, they are in the private markets. So, this dramatic shift from all these publicly traded companies 20 years ago, there were close to, 8,000 of them. Now there's about 4,500 all in all. Uh, well, there's a rise somewhere. There's a rise in private equity backed companies. So, private companies that are backed by private equity have risen exponentially, right? So, you have more money coming into the public markets being spread across fewer securities. Now there's thousands of them, but generally speaking, there's still much fewer publicly traded companies, um, and a ton of private equity backed companies. So this certainly has helped shape the current capital markets situation.
Yeah.
We have 7 companies that are almost 40% of the S&P. There's a reason for that. It's not just the success of those companies; it is what's been happening structurally to the markets.
Right.
So, and we'll cover this more in detail over time, I'm sure, but we're sprinkling it on you right now, so you
Yeah.
understand.
And I think to go back to the earnings conversation and the importance of looking at future earnings, this is where we stand as of right now.
Yeah, so the crystal ball expects higher earnings. So the crystal ball is made up of what's defining ourselves, um, the opinions of Wall Street in aggregate, mixed with the outlook and opinion of CFOs and CEOs of these large publicly traded companies. They give outlook guidance for future quarters and years. And what you see here is the combination of Wall Street expectations plus the outlook of CEOs and CFOs gives you this directionally accurate chart of where earnings are likely going to be not too far into the future. And you continue to see new all-time highs in earnings, which coincidentally, you have new all-time highs in the stock market. They are directly related to one another.
Great reason to be optimistic. And I also think if you're looking at the slide, the dotted yellow line is the earnings expectations for this year, and the dotted green is the earning expectations for next year, which is higher.
Quite an increase.
Yes,
Yeah.
absolutely. I don't agree with the title of this next slide, but maybe because I'm a fan of candy corn.
Yeah. So, all right. So, what we tried to do here is to show you the difference in the quality of corporations over a long period of time. And we're trying to illustrate uh, going way back, 20, 30 years ago, corporate credit quality and financials were, hit or miss. And now the quality of these companies has increased tremendously. So from bad to good, and we tried to implant something like candy corn, which is bad to get if you're trick or treating, and Snickers, which just about everybody likes. Um, but yeah, Jelena, look, I agree. I'm a fan of candy corn, right?
Yeah.
Only a handful, maybe a little bit less than that, because that stuff is really bad for you. Whoever created this slide, let's just say it's not me or you, tried to make a comparison that bad is candy corn and good is Snickers. So we're just going to go with it.
Yeah.
So below, the content just shows corporate credit quality, leverage ratios, interest expense, debt makeup has gone from, the past maybe 25 years ago, um, mediocre to sometimes not great to exceptional over time,
Yeah.
as illustrated through number one, credit quality on the top left, financial leverage on the top right, significantly less of it, net debt to market cap versus GDP on the bottom left, to debt makeup in the center, and then on the bottom right, fixed versus floating, and everything has improved.
Yeah.
So this doesn't get enough airtime. One of the main fundamentals driving this bull market is corporate balance sheets are cleaner, more stable, and significantly more liquid than maybe they've ever been in history.
Hmm.
And it takes a while for that to change.
Yeah.
And I'll go out on a limb and say, look, we're 3 years into a bull market. We have the Fed cutting rates again, 3 years into a bull market, which creates this unintended stimulus. And they're not doing it to create stimulus; they're doing it to move from restrictive territory to normal.
Yeah.
Um, I think we'll end up having one of the longest bull markets in history before this is all said and done, which means there are many years left to go. So
Yeah.
fingers crossed, and we shall see. But this slide is a very good backdrop to assist in that narrative.
If there were any cracks to find, these indicators would be telling to us.
Yeah, if we showed you this and it looked horrible,
Yeah.
trust me, there's some horrible stuff on its way, but it's the opposite scenario right now.
Yeah. No, that's great. Thank you. And I also, oh, excuse me there. When we talk about innovation, it's interesting to see that the US continues to lead in this space.
Yeah, we talk about the US has been quite dominant over the years when you compare its capital markets and indices compared to the rest of the world, even more specifically Europe. Well, there's a reason for it. The creation of new companies in the 21st century, you just compare Europe versus the US. This is a great slide from JP Morgan, not only illustrating the dots as companies, but also the size of the dot and its market cap.
Mhm.
So this is a chart of dominance, capital markets dominance, and you can also say economic dominance.
Yeah,
It's so related. There's no comparison here. The
right.
U.S. has just been a powerhouse and continues to be, and will likely continue to be um, for some time. I believe that Europe and other parts of the world are waking up to the fact that they need to encourage a more pro-business stance, maybe even assisting in some of these companies to help them go public, remove some regulatory barriers. But um, the U.S. is the place to be,
Yeah.
and I believe it continues to be that way and will be that way for some time.
And it's been more diversified as well.
Absolutely.
Yeah. And which leads to the next slide. It's no surprise then that the equity market, US equity market, is owned more and more every day by foreigners.
Yes, more stocks, please. So you hear these narratives out there that there's less investment from overseas investors, both governments, corporations, and individual investors, happening nowadays in U.S. companies. And the truth is the opposite. The share of U.S. equity market owned by foreigners is once again at an all-time high. Uh,
Hmm.
and I believe that will continue to rise, and that's current. So, there is some talk about, yes, the bond market is seeing less inflow from overseas dollars. But remember, our bond market, we are the world's piggy bank. So when foreign countries and businesses have excess reserves, they park it in the US because it's liquid and they know it's guaranteed and all that fun stuff. They can get access to it immediately. So they use us as a parking lot for excess cash, right? Well, there are times where they need the money, like now, because the rest of the world isn't doing so great, and they need to promote things and stimulus and spend money to get things started again. Well, when that happens, they have to pull their excess reserves. It's like if we go and buy a car, we need to put money out of our account to pay for it.
Yeah.
Well, they do the same thing. So I wouldn't focus on the fact that there's less money going into our bond market from overseas. It's because they need to use the dollars,
Hmm. Yeah.
right?
Yeah. That's great.
So,
Thank you. And we have one more slide on the markets. We need to address the government shutdown that we are currently in. And as a reminder, this is not the first. We've seen more than 20 of them going back to the 70s, as we show on this slide.
yeah, the threat of a shutdown happens feels like every few months. The actual shutdowns happen frequent enough to know that it is a hollow threat, generally speaking. On average, they last a little over a week. How does the market do during the period? It's slightly positive. And how does the market do on average 12 months after a shutdown? It does great on average. Nothing to see here. This is probably the most overused leverage point in government
Yeah,
that we have nowadays. And, um, you know, nothing to see here.
right.
Yeah,
I do like to highlight, though, that the last government shutdown was back in 2018, in President Trump's first administration. We were also concerned then around tariffs and inflation, and that lasted for 34 days, and the markets did incredibly well. The S&P was up 20 over 23% the following year.
exactly.
So the markets tend to look through this.
Yep.
Yep. Let's move on to the economy and policy, and we are going to start with the conversation around the Fed, as usual.
Yeah. So the Fed's corn maze. I wonder if anyone picks up on this. So what we have here is their most recent written forecast. So every calendar quarter, they come out with something called the SEP, Summary of Economic Projections, and they put on paper their thoughts for the short run, intermediate, and long run. And this is it.
Yeah.
So what they did here from June is they increased their economic growth forecast from a lower level to a higher level, so more growth. They pretty much said, "Hey, we think the unemployment rate is about right. There might be maybe a little bit less after some reports come out with adjustments." Their view for inflation looking into 2026 is it'll be much lower, to the tune of maybe 20% or so. Um, and then at the bottom, what really matters is their view of where short-term rates will be, of which they control, mind you.
Yeah.
And their view is rates will be about 100 basis points lower. So they started with one cut in September. And according to their language, what they said is, hey, expect potentially a few more cuts this year.
Hmm.
And then if you look into 26 and 27, right next to that yellow rectangle, there'll be even more coming. So ultimately, what they're saying is they are going to stop somewhere around 3% for short term rates. And that means there's about a full percentage point, slightly more than a full percentage point left to cut until they're all said and done with their move.
Yeah.
Um, we'll have to just agree with them. I think the thing that will change is will they get there slowly or will they get there quickly? I think we'll end up getting there quickly
Hmm.
because there's a part of the economy that lives off of finance rates, and there's a part of the economy that doesn't. And the consumers that are in the part of the economy that live off of finance rates aren't doing as great as the part of the consumer and economy that doesn't rely on
Right.
finances, if that
Yeah.
makes sense. So
Yeah.
I think the Fed will participate. They'll continue to receive pressure not only from Republicans but also from Democrats, because rates. We have an interest rate environment that is too high right now, especially when it comes to financing cars, financing homes, and big ticket items.
Yeah.
So I think the Fed is now addressing that and will continue to do so.
I would also highlight that this was the path we expected, and we've been talking about this since January.
Yeah, we thought they were going to roll out a smoother, less emotional path. Maybe, starting in January, cut once a quarter by a quarter and then make adjustments as needed. But no, they didn't do anything until September.
Right.
And, now it's they're like a little stir crazy, tinkering with not only their language, but these charts, cutting rates,
Yeah.
the promise for more. I wish they would lay it out in a smoother way and execute in a smoother way, but it is what it is.
We got the path right, we got the pace wrong, but
Yeah,
go figure.
exactly.
Okay.
Yep. Yep.
And we also we can take a look at the 19 voting members, and maybe this might explain the reason for the pace.
Yeah. So a dot represents one of the voting members of the Fed. And this is from left to right, 25, 26, 27, 28, and long term left to right. And each voting member gets a dot. They place it on the board. And just so everybody sees it, there is no consistency amongst the voting members. They're sort of all over the board. But if you zoom out and look at the trend, it seems like everyone agrees that the trend is to move rates lower, right? So you could see the aggregate dots kind of trend lower. And then that is represented on the prior slide with the numbers. But you know, in some cases, I think they throw their dots all over the place just to make it seem like they have some disagreement, because we've seen periods where the dots are on top of each other, and
Yes.
now they're starting to spread out a bit.
Yeah.
So, anyways, it looks very dazed and confused to me. But if you zoom out, the trend is definitely lower.
And it's interesting, despite the fact that it is a little dazed and confused with the individual members, the market is also predicting the lowering rates. The market doesn't always agree with the Fed projections, but currently they are in tandem. So
Yeah, the bond market and the stock market looks through all this stuff and they just price sort of the aggregate line.
yeah.
Yeah.
And let's talk about, as we're talking about the Fed, right? We have to remind ourselves that they have a dual mandate, which is inflation and unemployment.
Yeah. So what you see here is a long list of prior periods illustrated on a chart. So on the left, north to south, you have the inflation rate. On the bottom, from let's call it west to east, you have the unemployment rate. And the sweet spot, generally speaking, is low and to the left, not too low and not too left. But we'll call it the, if you squint, you can see a bunch of blue dots on top of one another and a bunch of yellow dots. And that's sort of the happy place for the economy and the capital markets, right? What does that mean? Well, that's a, normal inflation environment, uh, just north of two, and an unemployment rate that is right around, 3.5 to 5%, right?
Mhm.
That's full employment,
Right.
rounding error at times. Well, we're there. So you have the arrow that shows August of 2025 shows that we're right in that zone. So now, if we're in that zone, you check monetary policy. Hey, are we restrictive? Yes, we're restrictive for the time. So now we need to get interest rates back to a normal level. Why?
Mhm.
Because you run the risk of the dot getting out of that low left scenario and moving it maybe too far right and too far north, depending on the situation.
Right.
And then you have to take other measures, and that's something the Fed doesn't want to do. So they are going to turn down the temperature on their interest rate policy, and that's what we got.
Yep.
So hopefully they continue to do so because that's what we need.
Those red dots and green dots also indicate a time that we saw some tremendous volatility.
Absolutely. Yeah, you don't want to be a red dot or a green dot. That means policy needs to change quickly.
Yeah.
Either we have inflation that's too hot or unemployment that's too high or both.
Yeah.
That's not a great scenario. So we are nowhere near that right now.
That's great.
Mhm.
And as we talk about inflation, let's talk about the one of the largest weightings of inflation, which is housing.
Yeah, so the silver bullet of housing that will take out the werewolf that is inflation is important. So housing is an enormous weight in the inflation calculation. I won't get into how it's calculated, but it's rent based, even if you own a home. You just have to make up a number. So, generally speaking, it is housing that is taking and will take inflation lower. Why? Well, right now we have a scenario where there's a ton of listings outside of the Northeast, of course,
Mhm.
and prices have come down quite a bit and are probably going to continue to head down nationwide. The Northeast is unique because there isn't a lot of space to expand, so there's not a lot of new builds. Number one, number two, it is expensive. Number three, the Northeast is crowded and known for its good medical and education facilities, so it's in demand. And then you typically see empty nesters sort of move out of the Northeast, right? And they flee to other areas. So the Northeast right now has no inventory, and the primary struggle right now is financing. So rates are just too high. So with the Fed acting to move rates on the short end, it does have some influence on longer term rates, which has a direct influence on mortgage rates and car loans.
Mhm.
I believe there'll be a program announced by the federal government over the next 3 to 6 months that will directly target housing and housing home financing. They may even get the banks involved to provide some liquidity for it.
Yeah.
Stay tuned. That is something we talked about a year ago, and we think we're getting closer to them rolling something out.
Right.
We will certainly let you know when and if they do. But we look for housing and its data and weight in inflation to be the silver bullet to take inflation lower.
Got it. And I think another visual in regards to housing, there's some staggering statistics in here as to how much it's changed over the last few years.
Yeah, and something has to happen. I mean, prices have come up, quite a bit over the past 5 or 6 years, but it's not even price that is making it unaffordable. It is has more to do with finance cost, right? So when the average rate on a mortgage, again, financed over 30 years, was below 4%, and now it's just about 7%. It doesn't sound like much, but when you cast it over 30 years, it compounds to an incredible increase
Yep.
in total financing, then brought back to a monthly payment. And what you have is, the average mortgage 5 years ago versus the average mortgage today is about double. It's about a 92% increase.
Yeah.
And that gives you the record level of unaffordability that we have today in housing.
Okay.
So while you can't just, cut prices of real estate, you can adjust the cost of money, interest rates.
Yeah.
So I believe the Fed has short-term influence, which has some pulling power on rates, pulling long-term rates down. Plus, I think there'll be some type of program that is rolled out soon from the federal government. The Treasury Secretary Bessent has whispered a few words about it here and there, which tells me they are actually going to work on something.
Okay.
Yep.
Great. And the last slide we have in this section isn't so much a visual, but it's more of a list. We talk about our optimism and we reference a lot earnings. However, it's not the only indicators that we look at. We look at all of them.
Yeah, I mean, there's a lot of other good stuff that nobody talks about. Things like trade policy uncertainty. It's a trackable index is improving. Economic policy uncertainty is improving. Business conditions are improving. CapEx spending is improving. Jobless claims are low. Bank lending is growing. Bankruptcies are low. And all of these are positive for the economy. And if you don't believe what I just said, the next two slides are the backup data for all seven of those data points.
Yeah.
So feel free at your leisure to look at these charts. It is real data, not just opinion. You can see
Yeah.
it there for yourself, courtesy of Apollo.
Yeah. Thank you for referencing that.
Yeah,
After the multiple times we've gone through this, I forgot we had the slides in here.
yeah,
So,
yeah.
so let's talk about the everything else. We have a few things here, and let's start with power.
Yeah, jack-o'-lanterns needed. Really the light that comes from them. So everything we do nowadays and everything we use nowadays tends to be attached to the grid in some way, shape, or form. Everything has a power button. Whether it be charging our EVs or fueling our home, turning on a cell phone, connecting to Wi-Fi. Without power, we don't have any of this. And nowadays, we don't have societies that are accustomed to living in the dark and playing outside. We are plugged in, tuned in, connected all the time, 24/7. So, number one, without anything like artificial intelligence and cryptocurrency and all that stuff, we need more power, and we have grid issues. Now, add artificial intelligence, the demand from cryptocurrency and other technologies. Wow, we really need a lot of power. Yeah, so power demand and power spend and data centers are rising. So one of the hidden themes within client portfolios is this power play. It's kind of sprinkled within everyone's portfolio. Some of you see it directly, some of you see it indirectly, some of you don't see it, but trust me, it exists. This is going to be a theme that will allocate to more over time. But without power, trust me, there's going to be a heck of a lot less fun, innovation, growth, and good things. So you're starting to see these mega companies spend money on capturing their own grid, power plants, power supply, because they don't want to be blamed for creating brownouts and burnouts and all that stuff.
Mhm.
So stay tuned on this theme. a lot more to come on it and a lot more exposure in our clients' portfolios.
Just one of our themes going forward.
Oh yeah.
Absolutely. And one more slide in regards to the government shutdown. I think this is an interesting one in terms of carving the narrative pumpkin.
Yeah, so the government shutdown, right? So this is like a micro shutdown. Um, the money's been allocated, just the check hasn't been approved to be cut for discretionary spending. So just so you know, this scenario that we're going through right now does not affect mandatory spending. So there's no threat of Social Security, Medicare, Medicaid, anything like that that falls under mandatory spending, defense, all that fun stuff.
Mhm.
So this all falls under the discretionary lens, number one. Number two, this comes about because there are 12 appropriation bills that have to be approved each year. So once you approved the spend of the dollars on these various things, then you have this, let's call it monthly check-in to say, hey, we agree that we're going to spend money on this. Does everyone agree? Yes. And then it goes through. Well, this go round, there was some blockage of that, and that creates a shutdown.
Yeah,
Right. So I would say this one will likely be over by next week. Again, on average, they last about a week. Um, uh, to us, it's not a big deal. I wouldn't worry so much about it. It will probably lead to nothing. This is the most overused leverage technique in politics that exists today. I wish it wasn't covered as much. If it wasn't covered as much, it wouldn't be nearly as effective. Not that it's effective anyways.
sure.
uh, this is what the kids call a nothing burger, right? Is that what they say nowadays?
I
Um,
guess.
and we're gonna call it a nothing burger, and we'll move on from it pretty quickly.
Yeah, absolutely. And again, the markets look through this. So
Yeah,
we are going to end with it is Breast Cancer Awareness Month, where the studies show that 1 in 8 women are now diagnosed with breast cancer. Bob, you and I were saying I think all of us listening know someone, love someone that has been affected by this. And I am kicking myself. I really wish I was wearing my pink Fairfield Ludlow volleyball shirt that I will be wearing tonight with all of us in the room for the volleyball game will be wearing pink. So,
yeah, yeah. It's I've been impacted by this. Most of my family directly impacted by this. I'm sure everyone listening knows someone, or may even be directly impacted by this. So it's Breast Cancer Awareness Month. So raising awareness, talking to people, and sharing the facts and what you can do about it is so important. It's something to be mindful of. You can make a big difference if you spread the word and support the cause in any way you possibly can. And that's certainly something that we try to do here at Principal Wealth.
absolutely.
Yeah,
Great message. And I hope that the listeners today can sense the confidence, optimism that we have in the markets. So, Bob, as always, thank you for your insight. As always, we will have more in the month of November. There'll be more to talk about, I'm positive.
of course.
Of course. And for those that are listening, if you have any questions, concerns, you are always welcome to reach out to any of us here at Principal Wealth.
Great. See you next month.
See you next month, Bob.